Hello, good morning, everyone. My name is Vera. I work with CreditRegistry as the Senior Head Sales and Business Development. Just a minute for the screen to pop up. Yeah, all right. So welcome, everyone. My name is Vera Osuji. I work with CreditRegistry as the Senior Head Sales and Business Development. So today's webinar is organized by CreditRegistry Credit Bureau, the pioneer credit bureau in Nigeria, duly licensed by CBN, and a trailblazer in bureau analytics and industry innovative solutions. So before I start, I have this regular, it's become a constant. It's just a constant game I allow the participants to play. So kindly go to the chat box, just interact virtually, just put down your organization, your role, and should you want to change your career, what will be your preference? So I'll allow us a minute to just interact virtually, then proceed. Next slide, Nova. Okay, so while that is going on, I want to, these are a few house rules we have for today's event. So this webinar will be recorded. All participants will be muted to allow the speakers to present without any form of interruption. Questions will be dropped in the Q&A, not the chat. So should you have any question in the course of the presentation, kindly go to the Q&A and drop your questions, or you can use your raise hand feature on Zoom, but preferably kindly drop your questions on the Q&A. If you lose your internet connection, please proceed to report the link you used to join this webinar. And also this webinar will last approximately 2 hours, 30 minutes. Also, I want you to know that the recording of today's presentation will be shared with everybody here. So thank you once again for joining us today. The next 2 hours, 30 minutes will be quite insightful, and I believe you're going to watch your time here. So the webinar, our webinar today is the maiden edition of the Progressive Lender and the Bureau series, and the title of today's series is Bureau Retrospective Analysis. So I have a question for us before we proceed. So for lenders here today, do you think that the Bureau is a success partner? Do you think that you're going to be more successful by exploring all that the Bureau has to offer? You could just interact, you could just drop that on the chat box. Okay, I can see the chat is already ongoing on my first question. Someone said, if I would love to pilot, I would love to fly. So while I allow us to answer that question, really. So today's webinar, like I said, we're going to be looking at the title is the Bureau's retrospective analysis. The fact is, I would believe that the credit bureau is a critical infrastructure in today's credit business globally. And today we're going to discuss the fundamental value our bureau offers that some lenders here today are possibly not aware of. Now, what is the direct correlation between the success of a lending business model, the new product you want to launch, and possibly your existing products and the credit bureau? So I believe that at the end of this webinar, our goal is to establish that the partnership between the bureau and the lenders is akin to a marriage relationship. Next slide, Mecca. All right, so while I want us to, this is what we're going to be doing today. So we're going to discuss on local current percentage of non-performing loan and the role of the credit bureau, the role of the bureau data in credit scoring systems. We're going to be looking at ID verification, data cleansing and fraud prevention. We're also going to have testimonials by 2 institutions that have explored analytics as a bureau. We have a lot of speakers. We have Jess Fremantle. The next slide. So I want to briefly introduce our speakers to all of you here. So today we have Jess Fremantle, the Chief Data Scientist of CreditRegistry. We have Emeka Ezike, Team Lead CreditRegistry. We also have Dr. Yinping Liang, Group Director, Decision Science, Kuda. And today also joining us today is George Badojo. He's a Managing Director, Money in Minutes. I also have Jeremy Rams, Senior Partner, CreditRegistry, Prevento. So I'm delighted to introduce the next speaker to us. Next slide. So to start the webinar, so ladies and gentlemen, please meet the next speaker. So I have Emeka Ezike, who is the team lead here in CreditRegistry. Emeka is currently our lead engagement executive, and he has over 15 years experience, and he has worked in several banks, including Guarantee Trust Bank, Sky Bank, and Union Bank. Emeka holds a Bachelor of Science in Economics from the University of Nigeria, Nsukka. He is a trained business analyst and a certified project manager with Google. Over to you, Emeka.
All right, thank you very much, Vera. Good morning, everyone. So today I'm going to be speaking on the local current percentage of NPL and the role of the bureau. Okay, let me just dive into it. We all know that non-performing loan is a huge problem for the financial industry. Defining this, looking at what non-performing loans are, it says here that it's money borrowed by for which the debtor has not made scheduled payment for a period of 90 days. Okay, so it means that in your books, when you have funds that you've given out and the person that took the money has not made payment for a period of 90 days, is classified as a non-performing loan. This is not really a new problem. It has always been there, but it's also a problem that can hurt the financial stability of the players in this particular field. A couple of factors were highlighted here as main factors that are behind high NPL. Okay, the first one is inappropriate credit risk management, which is exactly what the governing body in Nigeria is currently trying to ensure, that every financial institution has a governing what governs their risk management model. Irresponsible borrowing is also huge here. Economic downturn in the country is also one of the major factors that can lead to high NPL. I'll leave the rest. Let me quickly skip to the non-performing ratios that we've recorded over the period from 2018 up until date. Okay, so if you look at it, Nigeria has gone through various recessions. Okay, and we have bounced out of those recessions in different times. For instance, between 2018 and 2019, in 2017, Nigeria entered an economic recession between 2016 2017. Okay, but the beautiful thing about that was that in 2017 was when the Credit Bureau Act was when the Credit Bureau Act was put in place to ensure that lenders must utilize the information from credit bureaus before they give out funds to borrowers. Okay, that created a lot of stability in the financial ecosystem. Now, in 2018, between 2018 and 2019, we also had APCON. APCON was able to operate positively to ensure that liquidity was available for Nigerian banks. Now, coming to the other side, by my right hand here, which also looked at what happened in COVID. I mean, COVID, nobody saw it coming, really. COVID shut down. There was global economic meltdown. Central bank had to introduce the minimum loan to deposit ratio, which was around 2019. But coming into 2020, when COVID entered, when COVID came, we all didn't just have anything to do. We just had to continue like that. But the beautiful thing was that the credit bureaus were also there to consistently support and create that landing platform for companies to obtain reliable information that infuse integrity in their decision metrics. Okay. Now, diving out of that, because of this utilization, if you come to post-COVID, now look at what happened there. In 2021, as at 2021, the NPL ratio was sitting around 4.9% in 2021. Now, as at today, okay, as I sit with you, as at end of December, the NPL ratio as at today is around 4.2, which is beautiful, okay, 4.2%. Now, these are our recommendations as a bureau. The first major things for lenders, if you are on this call and you're listening to me, is that number one, you must have to optimize your utilization of the value-added services in the credit bureau, especially the one for credit registry. I'm going to dive into that in a bit, okay? And of course, enlightenment on your credit risk management and also amplify your corporate governance practice, okay? One of the other recommendations that will really help stabilize the NPL is when we have political stability and better economic reforms. Now, coming to what the bureau can do for you. There's a saying here that a skilled workman is one that knows how to use his tools. Okay, you have a lot of tools at your disposal to help you to consistently mitigate against huge NPL in your books. Okay, the first one here is the Credit Registry Retrospective Analysis Services. Okay, what this tries to do is that it takes advantage of the belief by measuring a set of predictive variables. Okay, it looks at what has happened in the past and gives you an idea of what can happen now based on some statistical models that we have in-house. I'm going to leave this really for the experts. I'm sure in the next few sessions you'll hear this from the industry expert himself. So he will do justice to this. But coming down to the second product here, which is a must-have, is a must-have for every lender on this call, is a credit registry portfolio monitoring report. This allows you to dimension your portfolio. It allows you to see your portfolio on a spreadsheet. Dimension your customers, looking at it from 4 different angles. The customers that I can manage, customers I can market, customers I can mitigate, and customers I can mine. Now, this is classified in the 4 different performance codes, which is customers that you have that are performing internally and also performing externally. Those also that are performing internally and not performing externally. Those performing externally but not performing internally, and those performing internally and not performing externally. Now, what this allows you to do is to put in strategies, different strategies around these customers to ensure your portfolio is always protected. Okay, one of the good things here is that it gives you what we call advantage against huge NPLs. The third product I'm going to talk about here is our credit registry campaign report. Now, campaign report is like having a tree in your house, okay? Being able to stretch your hand and pluck the ripe fruits without stressing yourself. So what this allows you to do is that it helps you determine customers that are in your portfolio that are credit worthy, and you can convert them from being liability customers to asset customers. Okay, so this allows it allows you to improve your turnaround time, allows you to quickly just sell your products to the right set of customers without stressing yourself. And then the last product I'm going to be talking about is our skip trace. Our skip trace. Ever had a situation where you couldn't find a customer? You have all the details, but you can't just reach the customer. Well, we've got your back. Yeah, we have your back. So all you need to do is use our skip trace. We'll give you alternative information concerning that customer. Every information this person has used or somebody related to him has used before, you have that at your fingertips. And in that way, you'll be able to trace that customer to wherever it is and be able to make recovery of whatever facility you have availed to that customer. I believe with these four tools are beautiful tools to have in your arsenal. Make sure you reach out to us, and I'm sure that we'll be able to do something awesome for you. Vera, over to you. Thank you so much.
Thank you, Emeka, for that presentation and the insights on our value-added services. So, ladies and gentlemen, I'm delighted to introduce the next speaker. Yeah, so let's meet the next speaker. Our next speaker is the Chief Data Scientist here in CreditRegistry, Jess Fremantle. So Jess began developing scoring systems as far back as 1985 when he graduated from New York University. And he worked with, he spent most of his years of experience with Experian. And for the past 23 years, Jess has engaged more than 20 clients across Europe, Australia, and South Africa, advising them on credit scoring best practice, training and monitoring staff involved in credit in scorecard development. These engagements were across a spectrum of retail lending operations, including banks and retailers, mobile phone operators, finance houses, home loan providers, and also credit bureau operators. The most sustained client relationship that he had was a 14-year engagement with Standard Bank, the largest retail bank in South Africa. In his 40 years of experience, Jess has been involved in the development of hundreds of scorecard projects across the customer life cycle, right from prospecting to account acquisition, account management, and debt recovery purpose. We are delighted to have you in our midst today, Jess. Over to you.
Thank you, Vera. Thank you for describing my life in this field of credit scoring. Just before I start talking to the slides that I've prepared, I'd just like to say, firstly, I'm very pleased to be here to be speaking to everybody. But what I'm not going to be doing today is trying to tell you what the sort of financial benefit of using credit bureau data is. I'm not going to be asking the question, should you be using credit bureau data? I'm going to be assuming that is already known in the market. I mean, across the world, lenders use credit bureau data in their scoring systems, and there's absolutely no reason why that shouldn't be the case in Nigeria as well. So I'm going to assume it's a given that you need to be incorporating bureau data into your decision tool. So with that in mind, could I perhaps, Emma, could you perhaps show my first slide, please? Great. That's fine. Now, this slide is really talking to the need for credit scoring in general, not just bureau data. It's, you know, you can see all of the different types of information that we have available to us when we make a credit decision. It's vast and it's diverse. You have data that you've gathered from application forms. You've got data from previous customers, previous customer relationships. You've got credit bureau data. It's complicated. The complexity of all of this information is the reason why credit scoring exists. And what credit scoring does is that it distills all of this data into a single metric or a single value, which can then be easily used in credit strategy according to a lender's credit appetite or risk appetite to determine who they're going to accept and who they're going to reject. So that's this slide was meant to look busy because that is the busy problem that faces us. So perhaps my next slide, please, Amika. This is my simplest slide of all, so it will take me approximately 20 seconds. But just to make sure there's nobody in the audience who doesn't understand what a credit score is, I thought it was just worth making the statement. It's a numerical expression or a number, basically, based on statistical analysis that represents the creditworthiness of either a consumer or a business. Now, by convention, and rather sort of paradoxically, a low credit score means high credit risk, and a high credit score means low credit risk. That's the way it's always been. In terms of consumers or businesses, it first became established in the consumer segment. And in terms of businesses, it gained traction, particularly amongst small businesses, sole traders, SMEs. If you get into the very large corporate sectors, then you can still justify spending human resource making decisions on vast credit extensions. So next slide, please, Emeka. You could perhaps build this slide. Thank you. That's fine. Just stop there. There's a concept in statistics, which some of you may have come across, which is that of sufficiency, a sufficient statistic. Now, what do we mean by a sufficient statistic? It means that there's nothing else which can tell us anything else than the statistic that you're looking at. So if we're looking at a credit score, in the example I've given at the bottom there, if the bad rate at a certain score means 5%, then regardless of whether you're an owner or a renter or a young person or an old person or an unemployed person or a professional person, whatever, your bad rate should be 5%. Everything should have been discounted in the creation of that score. Now, that if a score is to be used to make a credit decision, it needs to be a sufficient statistic. If there is anything else that modifies that risk estimate, then you cannot just use the score to make the decision. Now, there are some scores which are plainly not a sufficient statistic. A bureau score is not a sufficient statistic because it doesn't take account of all of the application data that you'll be gathering during your decision making, and it may not take account of some of the existing customer data that you have. So the Holy Grail, that's why I put a picture of a knight on this slide, the Holy Grail is that you create a solution that is a sufficient statistic. So for example, a bureau score would need to be combined with your other data sources to make it a sufficient statistic before you can then start making decisions off it. Next slide, please, Emeka. I'm going to talk a little bit about the way that credit scoring systems are built, because that knowledge is essential to understand how you would incorporate bureau data. So, credit scoring has been around for 60 years at least, longer than me. And the way that scorecards are built is that we go back in time. To give ourselves the benefit of hindsight, we go back to what we call a sample window period, which is usually a 1-year period. And the reason why it's a 1-year period is because of different sort of seasonal effects that may happen over the Christmas period or over the summer period. You wouldn't want to build a scorecard just based upon applications received during Christmas, for example. So we always take an annual period. And from that period, we're gathering all of your applications for credit and all of the data that was available to you when that decision was made. On the right-hand side of this chart, we have September 2022, which is a year later, which is what we call our outcome point. And that is where we're defining which accounts performed well and which accounts did not perform well. Now, the definition of a good account or a bad account is something that which will vary from project to project. I mean, some lenders will use the Basel definition of default as their bad definition. Others will have a definition that is more operationally set, and not everyone needs to conform to the Basel Accord. So good, bad definitions tend to vary from lender to lender. The sample window period should be representative of the current and future environment, because the main assumption to this approach is that the past will predict the future. So, when we're discussing how we're going to create that sample, we're trying to make sure that it's relevant to today's business. So if you, for example, if you had some product types that are historical, that are no longer applied in the market or offered in the market, we would exclude those cases from the sample, because that would make the sample less relevant than it needs to be. So there's a discussion when you're creating samples as to how you make it relevant to the current environment. But the most important thing is the bottom point there, which is that when we analyze potential scorecard variables, and that's what I mean by predictors, that has to be information that was known at the time that the decision was made. It cannot be information that was gathered from after that point in time, because then it no longer becomes a forward-looking predictor of behavior. It may well be a backward-looking consequence of someone going bad. So it needs to be a forward-looking predictor. Next slide, please, Amika. So in terms of gathering data from the point when the decision was made, there are a couple of things to look out for here. Now, firstly, application data. We need to be careful that information hasn't been updated after the decision was made. And that can happen depending on your IT infrastructure. Things like the customer age, your contact details, as and when you get to hear that someone's changed address, or they've got a new telephone number, or their age is incremented, you'll tend to update your databases. But from a credit scoring point of view, it's very important that you retain that information also from the time when a credit decision was made. So that information is what this is the term retrospective that this whole seminar is based upon. The information needs to be retrospective. For existing customer data, ideally that information would be stored at the time when a decision is made. But if not, then you need to go through your archive files, your history files, and gather that information as it was when the credit decision was made. And the same is true of credit bureau data. Now, lenders, will tend to store credit bureau data. So you can use that information yourselves, but then you have to ask the question, have you gathered that data for every case? I mean, you may use CreditRegistry, but do you use this for 100% of your cases, of your inquiries? Do you use other credit bureaus? So, you may not have all of the information from a particular bureau stored on file. And also bureau databases and the way that we capture our data, the way our credit scores, those things change over time. So what you have stored historically may not reflect what we now are able to deliver. So what a bureau needs to do is to provide what is called a retrospective processing capability, or abbreviated to retro, where we can go back in time and give you the best view of our information as it would have been seen on a given historical date. Next slide, please, Amika. Apologies for this slide. It's not the most pretty of slides, but it'll at least give you notes in terms of what I'm going to talk about. So I've been working with CreditRegistry now for 5 years. And the very first thing that I started working on was what we're calling our retrospective system, because the use of credit scoring absolutely depends upon that capability. So what that retrospective system does is it converts raw bureau data into what we call summary bureau characteristics. Now, raw bureau data would be an individual account with an individual lender for a certain customer. But what these characteristics do is they measure across all of the accounts that are owned by a given entity. So then we can look at the number of different accounts you've got, your total exposure, your total balance, the time since the most recent account was opened. So those are kind of summary characteristics, which are a higher level than the raw bureau data. So I've given one example there, which is number of inquiries in the last 90 days, which inquiries are a predictive data asset across the world. What we also do is segment our data by the type of subscriber that supplied the data. So if an inquiry is performed by microfinance lenders, then we have separate characteristics which count the number of microfinance inquiries. The different categories we have off the top of my head are commercial banks, microfinance lenders, OFTs, telcos, retailers. I think there might be one other which escapes me, but basically all of our characteristics, we also have a total view, but we also break them down according to the type of lender from whom the data came. So we've got about 250 of these things. Not all of them, I'll be honest with you, not all of them are populated at this point in time. We're providing for the future, and our data asset plan in terms of the data assets we're hoping to acquire in the future. And it's drawn basically from international credit bureau. I mean, I used to work for a credit bureau in the UK. I've worked with credit bureaus in other markets, in other countries. So the start point was basically, looking at sort of a pooled set of characteristics that have been used internationally. But we've also added to it characteristics which have been the result of research we've conducted within Nigeria. It will come as no surprise that those characteristics were used when we developed SmartScore in the latest version of SmartScore. So although there are 250 SBCs, approximately 40 of those are used in our own generic bureau score. So lenders have got the option, and both these SBCs and the scores are available via API as they are through retrospective batch files. So once you've developed your model, you can then implement them on a like-for-like basis. So what does the retro do? It calculates our SBCs and scores as of a given application date. We've got a couple of different options here. One is to take your application date. We usually subtract 2 days because we want to be absolutely certain that the information we return would have been available to you, would have been viewable. And there can be delays in the way that subscribers supply data to us. So we put 2 days in to give a bit of caution. What we've started to do more recently is go to the month end prior to the application date. The reason for that is that our database is getting bigger and bigger and bigger, and these retro jobs are taking longer to run. In addition, our clients are giving us larger sample files to process. So the second option, if we're going to the month end prior to an application date, if we're taking a 1-year sample, that means 12 different dates. Option 1 would mean 365 different dates. So both options are achievable, but option 1 is basically more intensive and more costly for us. So it would cost more to our clients if they wish to have that level of detail. We support a large volume. Ideally we want 1,500 good cases, 1,500 bad cases. NTU is cases that were not taken up. We'd also like samples of rejects as well, so we can start looking at cases that you rejected that perhaps you shouldn't have done because they had decent credit bureau data. Now, in the design of these samples, we're very happy to help advise you in terms of how you're going to define good and bad. who you're going to exclude from the sample, what your sample sizes are going to be. This is part of the process. We'll give you that support, and you might find it a useful experience just to have that discussion with us. We've got a user guide which we can provide you with. Just have to send an email and we'll send you our documentation which describes what the retro is in more detail than I'm actually going to give you in this presentation. And at the end of it, once we've done the retro, we will then have a data set where we've attached all of our characteristics and our scores, and we can then return that file to you via an FTP site, which we can establish for you. Now, the reason I'm saying we would return data to you is because I'm assuming at that stage that you would be doing the analysis yourselves, that your own data science teams would take our data and assess how much value it would help, in terms of separating high risk and low risk cases. But if you don't have that capability in-house, you can also request that we perform that analysis for you. Lenders tend to prefer to do it themselves because obviously we've got a vested interest. But either approach has been adopted. Thank you, Anna. Next slide, please. This is an extract from our specification of all of the SBCs. So this is just about 20 of them. So you can see the first one, they've all got an individual unique name. VAR 20I is the total balance of all active accounts. And it says all, so that means across all types of accounts. 21A is looking at the average balance over the last 3 months. But when it says own company, it means only with accounts that are owned by you, the lender, the same lender. 21B measures across all of the commercial banks. C is the microfinance. So there you can see the segmentation that I referred to earlier. Variable 22 looks at changes in balances over time. So we're looking at a percentage calculation of the total current balance divided by the average balance over the last 3 months. So that tells you, is the balance on a customer increasing over time? Is it decreasing? And to what extent? 24 is looking at worst statuses. That's looking at the worst current status. We also have variations which look at the worst status over the last 3 months, the last 6 months, the last year, etc. So you can see there's many different ways. This kind of comes back to my very first slide, which was the complexity slide. Even bureau data is highly complex in terms of the number of different ways that you can measure it. So again, that's why scores come into their own. Next slide, please, Amrika. So how do we assess the data? Once we've attached our SBCs to a sample, and in this case, I'm looking at a sample of just under 14,000 cases where we've attached our retrospective SBCs. We produce what are called characteristic analysis reports. And this is a simplified version of a characteristic analysis report. So this is showing you the far left-hand column are the ranges of VAR 20B, which is total balance of all active accounts held with one of the commercial banks in Nigeria. So you can see there we've got 7 different ranges. So some of the sample don't have an account with a commercial bank, and there you can see the total balance of loans split into 6 different ranges. You can then see how that correlates with the future behavior. So this is the good, bad that's coming up, which I talked about just now, which is the performance with your account that you provided on the sample. So there you can see how the bad rate, the percentage of cases that goes bad, varies as the total balance increases. So if you had no active bank accounts, the bad rate was 6%. If you did, and you're with up to 250,000 Naira, the bad rate is 15%, then 14, then 18. So it's increasing as the amount of loans increases, and at the very top, it starts to decrease again. And that's a typical pattern, because to be given 4 million Naira in loans in the first place, you have to be a reasonably good customer. So that's one example of a predictive characteristic. I've got one more coming, I think, Emeka. So this is looking at how worst status, how that correlates with bad rates. So so you can see there that the bad rate varies from 7.6 up to 31% if the case is 4 months in arrears at the time of scoring. So these are both examples of predictive characteristics that could be used in your algorithms. I'm going to move on because I'm conscious of time. So this is our bureau score, smart score. So this is an illustration. So obviously when you do a retro, you'll be able to see exactly how well smart score separates risk for you. So this is one case study that we did where the bad rate varies from 38% at the bottom end to 4% at the high end. So clearly that is a score that's usable. So in terms of how to incorporate bureau data into your algorithms, there's basically 3 different methods. This method, which I'm presenting on this table here, is a typical scorecard. Here we're incorporating the individual characteristics. So worst current status is coming into your scorecard alongside information which you've gathered internally, for example, the age and number of inquiries. So that's one way of incorporating our data, is to put our characteristics in. Next slide, please, Emeka. Second way of doing it is to put our score into your scorecards as if it were a characteristic. So this is like a score within a score, if you like. And the third way, Emeka, please, is to keep the 2 scores separate. So here you've got your own internal score on the left, you've got our bureau score across the top, and you would then apply your credit strategy or RG, that stands for risk grade, within the cells of that matrix. So those are 3 different ways of combining data, and there are pros and cons. Option 1 is the strongest, most powerful solution because you've got all of those individual bureau items which can be customized to your business. Option 2, where you're building the bureau score in, is the simplest and easiest to maintain. You've only got one field in your scorecard that's coming from the bureau. It's easiest to maintain because we redevelop Smart Score from time to time, so you get the benefit of that. But it's not as transparent as option 1. In option 1, you know exactly how the bureau data is being scored, but in option 2, it's a bureau score, so we're not going to tell you exactly how that score is calculated because that is sensitive to us commercially. Option 3, when you keep the scores and the bureau scores separate, is the most portable solution. I mean, if you were to be using one credit bureau, it makes it easier for you to switch to using a different bureau, for example. I wouldn't necessarily encourage that, but it's obviously a consideration from your point of view, that portability. But it does break the principle of a score being a sufficient statistic, which is one of my first slides. And also it makes it more complicated when you want to change a cutoff because you've got 2 different dimensions. So how much does bureau data improve credit decisions? Well, it'll vary massively from client to client. It depends on what percentage of your applications do you find on the bureau. It'll depend upon how much internal data you have. It'll depend also on your payment mechanism. Are you only lending to people where there's a current account, where you can draw funds automatically with direct debits? So there's a vast difference in the extent to which bureau data will help you. So bad debt savings can range from anything between 10 and 70. Now, so I'm not giving you numbers here as to how much bureau data is going to help because there's such a big difference from lender to lender. And what these retros do is it now allows you to do an analysis and let the data tell you what is the data going to add to our decision making and how should we incorporate it. Thank you, Emeka. And my very final slide, I'm conscious I'm out of time. I'm sorry if I've been talking a little bit quickly to catch up. But there's one other use of credit bureau data in credit scoring, and that's in what we call reject inference. So when you build a scorecard, you shouldn't just be building it on cases that you accepted before. You also need to bring in the rejected cases because otherwise your model is biased. So in order to bring rejects into a scorecard build, you need to be able to determine which of those rejects would have been good and which of them would have been bad. Now, clearly, bureau data, if those rejects have been accepted by other lenders, bureau data gives you a handle to determine with more accuracy how those rejects would have performed had you accepted them. So thank you. I've covered a lot of ground in 25 minutes. And that's the end of my presentation. Thank you. I'll hand back to Vera.
Thank you so much, Jess, for your presentations. Jess has been able to do justice to how the factors that influence the predictivity of bureau data and the fact that it's based on lender by lender, and the need to use credit bureau score along other data and information that is available to you as a lender. So should you have any question, please, once again, kindly go to the Q&A and drop your questions. I'll be sure to address your questions to the speakers. So we have a Q&A session after all the speakers have spoken. So I will be introducing to us the next speaker. All right, so thank you. So our next speaker is Jenny Ramis. So Jenny is the senior partner, CreditRegistry Preventer. Jenny is a RegTech leader, serial entrepreneur, angel investor, and executive professional with over 30 years of experience across business, banking, fintech, RegTech, information technology, etc. He has specialized for the last 18 years in design and development of financial crime risk management, anti-money laundering, fraud prevention, identity management, and compliance solutions. Jamie is currently the founder and CEO of Preventer, a RegTech enterprise. He is also the owner and CEO of Consulting Integrating Services. We are delighted to have you in our midst today, Jamie. So the floor is yours.
Okay, well, let me share my screen. If I can you let me share my screen? Yes, okay. Sorry. Okay, well, thank you very much, Vera, for the introduction, and thank you, everyone. Good morning. I would like to start, sorry.
Oh, yeah.
All right. Are you looking at my screen?
Yes, please.
Okay. All right. Well, thank you again for the presentation, and thank you, everyone, for being present in this presentation. And today we're going to talk about how can CreditRegistry and the Bureau can help the Nigerian market in terms of the online lending. No, we're going to talk about digital onboarding, identity verification, fraud prevention, and how can we also use the data cleansing to help the companies to improve their data. Okay, one of the things that or the problems that we are facing is that organizations are putting the cart before the horse. They launch digital lending products before setting up their fraud prevention and losing a lot of money in the process. As we know, in this today's day, and especially after the pandemic, most of the business are in the need to go into the internet market, into the e-commerce market, into the online lending. So they're trying to go out, they're trying to get customers, but they forgot to first have a good fraud prevention program in place, right? So thanks to this, they have been losing reputation, customer trust, revenue, which impacts their bottom line and growth. And one of the things that we encourage the companies is that first, before you go out, before you try to onboard customers through the online, is to first have all the fraud prevention in place. right? So one of the big challenge that they're facing when they go outside is they have to have safety, customer satisfaction, and compliance. And these three factors are very hard to commit. One is, in one side, you need to have the security for your customers, to have everything in place that they don't, they're protected against identity theft. In the other side, the customers wants to have a frictionless, touchless, not invasive system. They need to have a good customer experience. If they don't have a good customer experience, they tend to abandon the system, and they don't want to wait. They want to have a good application, but also, you know, smooth and seamless. In the other side, we have the compliance. The compliance is telling us you need to have all these in place. You need to have all these procedures. You need to follow this. You need to ask these questions. But if we ask all these questions, we are going to lose the customer satisfactions. And if we don't ask the customer satisfactions, we may put in risk the safety. So all this applies for all online bankings, neobanks, buy now, pays later, micro lenders, mortgage, and peer-to-peer services. So risk must be considered in smart business practices, right? And we are in the market that the estimated growth rate of the global digital lending platform market is 25.9%. By 2030, it will have an estimated value of $44.5 billion. So that means that companies that are in the market already needs to be protected. Companies that are not in the online market needs to be out. Otherwise, you're going to lose customers because the competitors will going to get these customers. Plus, with this increase in the market of opportunities, it also increased the risk. It also increased the cybercrime. It also increased the other part of the market, right? They wanna get advantage of all these vulnerabilities that you can have in your system. So what do we believe? We believe that every company should have access to solutions that help them grow their digital offering safely. We are building, we build up a system, and we have services that can help you to go out safely, and you can have all your digital offering in a good way. We offer a streamlined digital customer journeys in a simple, fast, and fraud-free process while growing your business without frontiers. This is an example of what the digital onboarding can do on the online on the online lending. We're going to start with the credit scoring integration. This is a big asset that we have right now. Having the data of all the customers, having the data of the financial behavior, having the data of how, if they are reliable to pay or not to pay, if they are eligible to have a loan, a credit, a mortgage. This is something that we can use in order to do the digital onboarding before we have the customer already in the system, and we're suffering for something that we don't expect, right? So the second part is the digital identity verification. On the digital identity verification is where we want to make sure that the customer is the customer that they say they are. We are in this kind of process, we are not, most of the time, we are not having the customer in front of us. It's not a face-to-face relationship. It's a relationship across the internet. So we don't know who is the person in the other side. So for that, we need to make sure that the person is the same person. It has a good government issue ID. The person is alive. It's not a mask. It's not someone that is trying to do a Photoshop. It's not someone that is still an identity theft, that is stealing a document and is applying for a loan or is applying for a credit, right? So all this is that you have to make sure that the process is what I say in the previous slides is smooth, seamless, secure, but it's also under compliance. Another validation that we do is that we can validate again the NIA number to make sure that the person is who they say they are, but also to make sure that the person has active, is alive, is real alive. So we don't want to have surprises. We can also do another services, like we can verify the phone number, the email address in two purposes. One is to make sure that you have a good contact with that customer, but also to make sure that the person is in possession of the phone number and is in the possession of the email, so we can have a good way to contact with them. We can also do proof of address. We do a device intelligence, meaning that we can do the device tracking, everything that happens on the device, starting from the geolocation. And with this is more than just to know what kind of device it is. We can put restrictions. We can allow customers in certain geolocations, and we can restrict customers from another geolocation that we don't want. For example, you can have a person that is applying for a loan with a Nigerian document, but is in another country that you don't want them to be, right? Or it could be in the risk, in the high risk country that you don't want to allow them. We can do the AML checks, which is mandatory in the financial industry, is the anti-money laundering checks against the global sanctions list, OFAC, politically exposed people, etc. This can be totally automated. It depends on your compliance program. We can also complete the electronic know your customer, and your customer can be approved in seconds. No, after the customer is identified remotely and everything is validated, your compliance program, if it has with this, we have enough information to comply with the know your customer, it can be automatically approved. We can also integrate electronic forms for other questions that you may have or you may ask to the customer that is not in the identity document. Questions like it could help you to complete the know your customer, questions that it could help you to complete the lending process or the approval process, or questions that simply the compliance department is asked you to ask. No, like source of funds, for example, is a big question from compliance, and this is something that you may need to ask the customer after the process, after the onboarding, or before the onboarding, but we can do it here automatically. And at the end of the process, if the customer needs to sign an agreement, if this process is, for example, to open an account, to get a loan, to get any financial agreement, it can be signed through the electronic signature. So this process, the digital onboarding, it can be automated, or it can be translate your experience that you have with your customer face-to-face over the internet in a secure and safety way. And the most important is that you're gonna be in compliance, right? So this is the identity platform and fraud prevention services that with CreditRegistry we're offering to you. The identity verification is gonna be done by your customer, by your end customer as a self-service. They can complete an electronic know your customer, as I said on my previous slide, or the complete digital onboarding if you want to do multiple checks, if you want to include part of the process that you are doing normally today, no, that which is include the digital signature. So the identity verification is one of the main services that you can start with. This is something that can be done easily. You don't need to do any integration. You just use the business portal from CreditRegistry, and this is a demo that I'm gonna show you today. Another services that we offer is the authentication, meaning that this is for recurring customers. This is for the customers that you already identified, that you already on board, and then you want them to authenticate the person when they need to authorize a high-risk transactions, access to sensitive data, or a simple login. No, it can be done by the face recognition. We already have the customer on board. We already know who the person is. We already have their face. So we just need to compare faces to make sure that the person is alive every time that is coming to do any transactions with us. At this part of the authentications, if you want to use the one-time passcode just to make sure that with the email, with the phone number, we can also do that. And as I mentioned before, in any of this process, we are having the device intelligence, we have the device tracking, so we're gonna make sure that when this action is happening. We also do the AML screening, as I mentioned. This is mandatory for the regulatory for compliance. We screen individuals, entities, locations against the global sanctions list, OFAC, politically exposed people, adverse media. So this is services that you can check and you say, okay, I also want my customer to identify themselves over the internet online, but also at the same time, I want to do the AML screening. Data cleansing. This is something that is very useful to help you to clean your data. You know, we can do this in bulk verifications, bulk data. You send us the data of your customers. They can be done, for example, for the Know Your Customer updates or renewals that you have to be in compliance. The Know Your Customer normally has to be redone once a year. It depends on the high risk of your customer. It can be done for very high risk customers. Normally you do it between 6 to 8 months, but for medium and low risk customers, you do it once a year or every 18 months, right? And the beauty part of this is that this can be done by your customer. So this is a self-service. So we got the data, we ask the customer to help us to update the data, and you have the data updated, right? So, you know, those all process that your account officer needs to contact the customer to ask, you know, do you have an updated identity document? Do you have an updated phone? Do you have an updated email, updated address? Or you have to renew the customer information, can be done, you know, in massive process. So the next slide is gonna be the demo. I'm gonna show you how we're gonna do this part, the identity verification through the portal. Allow me 1 second so I can link my phone against with the, right? So I'm gonna do this. Sorry, 1 second. I'm gonna. All right, so Steve, sorry. Okay. Go here. Right. Okay. All right, we're here. So this is our remote digital ID platform that we have on the portal. Once you log in on the business portal, you have the option to start working with the digital identity verifications. Here you will have three options. One is to verify your customer remotely. The second one is to see the results of the verifications. You know, you want to send the invitation or you want to send a link to your customers to verify, but then after you want to see the results. And here is some of statistics of the usage that you are doing it, verification and invitation. So we're gonna start from here. So if you do the share with your customers, you're gonna invite your customers to asking to do the self-service digital verification, right? So you can do in three ways. You can do by email, you can do by phone number. If you do by phone number, you just need to select the numbers person and then send an SMS message to them, right? Or you can do a customer assistance, meaning that if you want to do this process face-to-face, or and if you want to do face-to-face and the person doesn't have a phone, a smartphone, or a phone that doesn't have a camera, or the internet is not working, etc., you can do this process at your branch, at your office, and you can do with your device, and you can assist your customer in front of you. For this demo, we're gonna use the email. So I'm gonna show you how they receive the email and what is the process that they will do. So here is when you send an email to your customer, right? And then we're gonna put as a unique identifier my same ID, right? So let me see why it's not working this. I'm gonna make sure that all right, sorry, 1 second. I think that you don't see my phone, right, B?
No, we're only able to see the launch pad.
The launch pad, right? So okay, all right. So I'm gonna register my email. I'm gonna send invitation.
You can share your screen again, though.
Oh. All right. Yeah. Okay. So after I send in after I send the invitation to my phone, that I don't know why it's not working, you're gonna see the results from here, right? So as I see, this is the verification that I've been done this morning, no? And then basically all the information from the document is appearing here. The images from the document, like for example, I'm gonna show you this one that is here, Miami's. So, and then you can see what your customer has been verified, no? The information, the document that he takes right? So let me, and what the verification has been done. All the process that he's been doing it, and the geolocation of where the person is located at the moment of the verification, right? So I'm gonna go back to here and just wanna make sure that I can share my phone. I don't know why it's not working, but yeah, give me 1 minute, sorry.
Hello. Hi, Jimmy. You can share your screen.
Yes.
Your screen.
Okay.
We have a few more minutes left, about 10 minutes.
Yeah, unfortunately, I cannot share my phone. I don't know what's the issue here. But here on the, as I mentioned, these are part of the services that we're gonna use. You're gonna share your invitation with your customer, and the customer will receive an invitation on their telephone. They can do the identity verification in a seamless process, and then you can see the results on here, right? So, and then another part of the information that you're gonna have is some of the usage of invitations that you send to your customers and the identity verifications, how many they are accepted, how many they are rejected, and how many needs to be reviewed manually by you. As I said, here it tells you if the invitation of the process has been completed and your customer has been passed the identity verification. You can see here that a 97% of the confidence score, meaning that your customer is the person who say they are. This is the selfie that I took. And
can you switch your screen? We're looking at the presentation. We want to see your browser.
Oh, you're not looking at my... Okay, are you looking at my browser now?
Yes, we are. Thank you.
Okay, sorry about that. So yes, so I was telling you that from the auctions, you're gonna verify your customers, right? So after you send the invitation to your customers, you can see the results, and here you can see the confidence scoring, the 97.3, meaning that the person who was doing the verification is the person. You can see all the information that we read from the document, and this information can be passed to your system if you need to, right? We can see all the images from the document, the portrait image from this document that is being used, the driver license. This is the back of the driver license. The system, it reads the barcoding information, it reads the OCR, the visual zone of the font of the document, and is comparing the visual zone against the barcode, right? And after that, we also validate against the NNA number. So it also shows you the selfies that the person took at this moment, and it also shows you the signature from the document, right? From here, you can see everything that has been done. The facial analysis, the liveness detection. This is, I have a failure because at the beginning I didn't move my head correctly. So it tells me that the liveness detection it didn't pass. So I did a second attempt and then it passed, right? It detects my document. It did the ID proofing, everything that from the document is legitimate, is secure, is a good document. And also it did the photo match. It means that it compares the selfie against the document to make sure that who is behind the screen, who has the document in possession is the same person as the document. And finally, it asks the customer if all the information is okay. So it confirms that the information passed. We also can see the geolocation of the customer. I'm sorry?
Thank you, Jamie. Your time is up.
Okay. Well, thank you very much. If you have any questions, please.
Sure. All right, so thank you, Jamie, for that presentation. Taking us through the customized process of digital onboarding, which is an innovation of CreditRegistry Preventer, from identity, digital identification, its verification to device intelligence, up to credit score integration. It is also quite interesting to see how seamless the CreditRegistry Preventer self-service is. So thank you. Once again, everyone here, should you have any question, kindly go to the Q&A and drop your questions. So we're going to move to the next speaker.
Hi, good afternoon.
Yeah, so ladies, I'm delighted to introduce our next speaker, Dr. Ying-Kun Liang. So Ying-Kun Liang obtained her PhD in economic engineering at the University of Kent at Canberra in 2008, where she worked as a research associate until June 2012. Ying started her career in finance sector in 2014, initially as a data scientist, and quickly progressed to the credit risk analytic domain. She is currently working with Kuda as the Group Director of Decision Science, leading a team of about 11 that handles everything that has to do with data, from provision of data, business insights to advanced analytics and modeling. We are delighted to have our next speaker. So over to you, ma'am.
Thank you, Vera.
You're welcome.
Sorry, yeah, my slides. Thank you. Good afternoon, everyone. So I'm Yi Qing. I'm the Group Director of Decision Science in Kuda. And today I'm here to talk about Kuda's business case for using CreditRegistry's services. In today's presentation, I will cover who is Kuda and Kuda's business case for using CreditRegistry's services and the full range of CreditRegistry's services that we received. And finally, a quick summary of today's presentation. So who is Kuda? Apologies, I think this slide is a bit old. I have newer version of the slide, but I'll try to talk through, hopefully I'll remember all the points that I have updated on the slide. So who is Kuda? Kuda is a digital microfinance bank that service the African market, and we operate a freemium model. Our mission is to provide financial services to the underserved population. Kuda was launched in Nigeria in 2019 by Babs and Musti. In less than 4 years, we have onboarded more than 5 million customers. More recently, we have launched to the UK, and we are expanding to other countries. Next slide. So Kuda's use case for CreditRegistry, we have two, taking one step back, in Kuda, we currently are offering an overdraft product, and we are going to launch a term loan product in Q2. And we have more revolving products in our roadmap. Sorry, this is the slides that I have updated and it's not here. So I will talk us through, that's okay. Yeah, if you just keep on our business cases, the use cases. Yeah, sorry. In Kuda, we currently offer an overdraft product, and we are offering a term loan product in Q2. And we have more revolving products in our roadmap. So as you can imagine, in every step of the credit product development cycle, we need data to help us make the right decision. So what data is available for us to assess credit worthiness? In addition to credit bureau data, there are data suppliers that provide insights using SMS messages and device data and telecom data, etc. However, the fundamental difference between credit bureau data and all the other data is that credit bureau data is designed to be a complete view of a person's financial activities, whereas other data types, they are behavioral traits that may or may not correlate with the customer's financial well-being. As you can...
Allow me to interject, please. Do you want to share your screen? Do you want to share your own slide? Because
okay, yes, I think that will be helpful.
Okay, so we're going to enable you to
screen. Okay. All right. I think I am here, so let me try to present.
Oh, good, you can see it.
Okay, can you see it?
Yes.
All right.
So yeah. Presentation mode. You just click the presentation.
Yeah. Are you seeing the presentation mode?
Yes, it's perfect.
Yeah, okay, fantastic.
Yes, thank you.
Thank you. So I was talking about the credit data and what data is available for us to make credit decisions. So apart from credit bureau data, there are suppliers that provide data extracted from SMS messages, device data, telecom data, etc. But the fundamental difference between credit bureau data and the rest is that credit bureau data is designed to be the complete view of a person's financial activities, whereas the other data, they are behavioral traits that may or may not correlate with their financial activities. As you understand, when a person takes on a credit product, this is a financial activity. So fundamentally, what determines if a person repay a credit product is their financial well-being. So in technical terms, the credit bureau data provides a cause and effect relationship with a person's financial outcome, whereas the other data, they may or may not correlate with that outcome. Therefore, we believe that the credit bureau data should be at the foundation of making any credit product decisions. So in Kuda, we have two use cases for credit registry services. The first use case is underwriting automation, and the second is credit scoring. By using the data provided in APIs from CreditRegistry, we are able to automate our underwriting process. And the benefits are it helps us to achieve scalability. It removes the subjectivity in the underwriting process. And it helps us to easily adopt A/B testing when we are launching new lending strategies. Coming on to credit scoring, the benefits of credit scoring is first and foremost, it helps us to achieve risk-based pricing, which helps us to provide competitive rates. Then it also helps the business to manage our risk exposure, and it protects the customer's financial interest. Next, I'll speak to the full range of services that we receive from CreditRegistry, starting from API integration and batch test support and retro data and summary block characteristics and in short SBC and smart score. And then I will delve into the retro data service and the smart score in the next slides. So retro service, what is a retro service? The retro service provides a historical snapshot of an individual's credit file. It is typically used in credit product design phase to formulate the day one credit policy rules. And the typical components of these snapshots are in the form of SBCs and the smart score. And the typical way that we consume this service is that we extract a big data set from the credit bureau, and we use statistical analysis and machine learning methods to form our day one credit policy. So through our exercise, our retro exercise, we gain two key insights. The first insight is match rate. By knowing the match rate on our customer base, it helps us to optimize our funnel conversion rate, and this translates directly to cost saving. And the second insight is a person's financial well-being and its correlation to their medium to long-term outcome. And this insight is captured in the SMART score, which I will provide a working example in the next slide. And what the retro service, our retro exercise also review is the challenges that the financial industry is facing collectively. So the first challenge we are facing is a low match rate. What this means is that a substantial percentage of our customer base do not have a credit file. In a conservative approach to credit product offering, a lender typically do not want to lend to these customers. So to the business, this means that we are missing out on market opportunities. And to the customer, this means that they're not given the financial leverage that they need to improve their lives. The other challenge is the data quality issue. So one of the examples we see in our retro data is that the long term was expressed in days as well as in months. So what this the result of this is that it rendered this column being this data field being not useful in our analytics, and hence is not being used in the credit product decisions. So I will, in the next slide, I'll provide a working example of how to make the smart, use the SMART score to help us make business decisions. So in this table, you can see that in the first column is the SMART score that is being grouped into 8 bands. At the top of the table is the low score end, which speaks to low credit quality. And at the bottom of the table is the high score end, which speaks to good credit quality. The second column shows the default rate at the score band and above. So what it means is that if you look at the top of the second column, it says 18%. That means the market of the market that we sampled, 18% of the customer went into default. And we can use this information to help us cut down our credit loss. And what the second column shows is that the portfolio default rates the business will experience if we set the score cutoff at the respective score band. So for example, if we set the score cutoff at 700, that will help us to bring down the default rate to 7% instead of 18%. So that is the working example of how to use the SMART score to help us manage the credit risk. Okay, so moving on. So in summary, through our use of retro service and the summary block characteristics and SMART score, we have gained very valuable insights that can help the business to improve funnel conversion rates, to reduce cost, and to automate our underwriting, and to improve credit quality. And last but not the least, the credit data quality is an industry collective effort. It operates based on reciprocal principles. So it starts with every and each financial organization to provide quality data. Then the contributor becomes a beneficiary of this exercise in the sense that the contributor will be able to make good business decisions using quality data. And therefore, I'll call for all the banks and lenders to contribute towards this positive feedback loop. That concludes my presentation today. And thank you very much for your attention, and I'm open for questions.
Thank you so much, Dr. Ying. Thank you. So we'll move to the next speaker. We're going to come back for question and answer session. At that session, I will have all the speakers come back here and answer the questions that we have. So please proceed, go to the Q&A box and drop your questions. Should you have any question you want us to answer in this presentation, please go and drop your questions in the Q&A. Thank you. All right, so I'm going to be introducing the next speaker. Our next speaker is George Badejo. George is the Managing Director, Money in Minutes. George is a UK barrister and a fintech entrepreneur with over 25 years combined experience in banking, finance, debt recovery, and civil litigation. He's currently the founder and chief executive officer of Money in Minutes Finance Company and a co-founder of Ethical Resolve Limited. Amongst George's many academic qualifications, he is also an alumnus of the prestigious University of Oxford, where he obtained his master's in business administration. So we're delighted to have you, George. So the floor is yours.
Thank you. Good morning, everyone. Thanks for the intro. As Vera said, my name is George Badejo Adebenga from MIM Finance. We trade as Money Minutes and also WageX in Nigeria. I'm in fact delighted to participate in such an important subject, the progressive lender and the Bureau. I think it's very point at this point in time. I think the three words, progressive, leader, and Bureau, speaks volume, and are indeed the operative words in that subject. To succeed or lead in the lending industry, especially in a country like Nigeria, one must rely on insightful information and data from credit bureaus. The bureaus have been in the industry, as you can imagine, longer than any lender that comes in. And by the nature of their services, they would have seen it all. And I think that's why the Bureau plays an important part in our kind of sector. If I may ask you to move to the third slide, that would be great, thanks. Okay, so who are we, MIM? We are a lendtech firm with over 20 years experience in providing consumer finance to perhaps I would say underserved individuals in the UK and in the US and very recently Nigeria. So far, these businesses have disbursed, as I identified here, over $20 billion to help thousands of people across those two continents. And I'm pleased we've decided to venture into Africa, starting from Nigeria. Our mission is very simple, make affordable finance accessible to as many people. And our vision is to provide a path to better financial health through affordable credit across Africa. And now this slide pretty much identifies our 5 values, which drive our conduct at MIM and also drives our behavior as an organization. I wouldn't waste too much time on there, but they're very, very important values that we believe that anyone that interacts with our business would see those values in whatever interaction we're having with the general public. So why Africa and why should we care, right? I guess the simple answer is that credit is undoubtedly the lifeblood of any economy. Because it provides the opportunity for people to start businesses. It allows existing ventures to grow. And also it allows consumers to make immediate purchases without the required funds. And this is how the economy grows. So it's a very, very important part of any economy. And also, if you look at it from a commercial standpoint, where most businesses like ours are also looking at this, apart from, or in addition to the impact aspect, is that Nigeria holds a growing large population of young adults. We have over 50 million people with formal bank accounts and over 99 million unique mobile phone subscribers. So the opportunity to solve problems via finance across Nigeria is immense. And of course, it can increase as well as we close the concerning gap in the unbanked consumers. If you could move to the next slide, thanks. All right, so this particular slide is really about what we've been up to. So if you move to the next, well, what I can say is for the past 2 years, we've been carrying out researches, we've been releasing beta products. I would like to call them experimental products. And that's what we've been pretty much doing. The whole idea is to identify as quick as we can product market fit. So the product that would work for the Nigerian consumers. Now here on this slide, I will share with you what we've experienced from our beta launches, but focusing on the challenges we've recorded, right? So I think the first thing we identified is the fact that there is poor financial literacy. And I'm sure you all are familiar with this challenge, right? And it pretty much rings true from all our beta launches in that so many of our people lack the understanding of finance, how to manage money. And this rings true in how they behave when they apply for a loan and also when they are obligated to repay. We also noticed high rates of poverty, right? And this is pretty much a big challenge as well, because it relates to pretty much everything. It relates to the very reason why someone would even consider getting a loan, you know, getting a loan to actually buy food. Perhaps you could kind of figure out exactly how that loan is going to perform. So the poverty rate plays a huge part. And I think we see so many finance firms pretty much just focusing on the top layer of the society because they just don't want to serve the bottom layer. And that equally is also a challenge as well when there is no finance available to all parts of people that perhaps can afford to repay. The fraud menace is also a very key issue. We particularly experience a huge fraud attack, mostly from a particular part of the country. And again, I think the prior poverty, I would say, drives that kind of behavior as well. And a very good reason as well why you should not just rely on what you know and your customers, but kind of leverage on some of the information the credit bureaus can actually provide. Entitled borrower is also one that rings through in some of our beta launches. And what we mean by entitled borrowers is that we found, especially after the loan has been granted, many people have this sense of entitlement, right? This sense that perhaps if you're not going to give me another loan, I'm not going to pay this, right? You know, or perhaps, you know, I don't have to pay you because what are you going to do about it, right? So that sense of entitlement. And I think it's also linked to this lack of, or this gap in financial literacy, because they really do not understand that if you pay on time and you pay regularly, right, most lenders would pay good money to be able to lend to you, but importantly, they would be able to offer you very, very cheap rates because they can predict how you're going to behave based on the information about your performance in prior loans. Unknown consequences is also something that kind of stood out. Again, linked to most of all the points I've mentioned before, people are kind of not compelled to repay, right? You know, they just don't feel any reason why they should pay, especially if it's a low ticket, especially if there is no collateral attached to the loan. People just don't want to pay, right? You know, and I think that was very, very a key factor in some of the challenges we face, especially when an account goes bad. Lack of data on creditworthiness, worthy individual was also a very important factor. And I think some of our friends have spoken earlier have actually touched on this point as well, right? But importantly, I think the more we can get more customers, consumers into the grid, the better we can kind of make decisions because those data are actually there. And I think the final challenging point, which is slightly positive, but also challenging, is the fact that there is demand, right? You know, there is demand, as we know about the population growth and the amount of people with mobile phones. So the demand is there, but the reason for the loan is of concern. And that is kind of the kind of challenge. Now, moving to the next slide, which you're already on, I think if you look at everything, you would think, why the hell do you want to carry on doing this? So I was like, yeah, run for the hills. But I don't think that's the case. That's actually a joke. So if you move to the next slide. Thank you. So it's actually a joke. I wouldn't say run for the hills, but I think the outcome of our experiment as somewhat, albeit we saw loads of challenging behaviors, but it allowed us to kind of better understand what a good customer looks like from the data we have and what a bad customer looks like. So I think there's no need for us to consider running for the hills. But what I wanted to just showcase on this particular slide is, you know, when we talk about good, right, what does good look like, especially for a country like Nigeria? So I can think about and talk about what good looks like in the UK or in the US, but then if you look at the Nigerian sector, what does good really look like for us? And I think I've identified 4 items here, which I'll swiftly go through. The first is an industry-wide data sharing culture across all credit bureaus. So this is what I see as a vision where, you know, things are good in this industry where, you know, every credit bureaus are sharing data between themselves and every lender also sharing data across all 3 credit bureaus. The second is the national adoption of the open banking regulation and technology. And I think this is key. And I'm pleased to say, I'm sure you guys are aware, Nigeria has become the first African nation to endorse and sign into law. I think it's still ongoing, but open banking is coming to Nigeria, which is great, which is you know, something that we should really be proud of as Nigerians, because this is going to be a game changer amongst other things as well that is in the pipeline. The third is an effective mechanism that compels borrowers to repay their loans. For example, direct debit, and direct debit actually working the way it should. GSI, which is also known as the Global Standing Instruction, which is amazing regulation, but yet to go live across the industry. But when those kind of solutions go live, where with your BVN, if you do not pay, if you pass a particular threshold, so we're talking about the can pay but won't customers, there is a solution without the borrower's consent to go take that money that they're refusing to pay. And I think that would really, really help as well. And also an effective legal system whereby, you know, creditors can actually take borrowers to court, you know, and be able to kind of go through the process within a record time. And I think all those mechanisms, if you like, would really you know, change the entire industry. And I think the final point is more technology-driven challenges of the status quo. But I think those 3 items at the top would most likely have to happen before you see more challenges coming in across the world to kind of complain Nigeria. But I see that vision based on what where we are and where we're going. So if we move to the next, yeah, you're already there. All right, so here, I think very, very important. We, following all our beta launches, we made a decision to engage CreditRegistry to talk to them about, this is all we've been doing. This is the result we've seen. We've got 100,000 transactions we've done over a short period of time, under 12 months. Right? And it's shown us different views as to what a good customer looks like and what a bad customer looks like. Is it possible for us to kind of also get information from you? There's got nothing just to do with us, but also to do with all your subscribers. And this is exactly what Jess was actually mentioning, right? So if we could get that kind of data, anonymized, of course, and try to analyze that data and see exactly what that's going to tell us. And we found the outcome of that retro very, very powerful. And that is because it's helped us not only validate our internal data analysis, but also it's giving us insight on highly predictive individual characteristics and data points that can now allow us to kind of know exactly how we're going to not only just underwrite, but also attract the right kind of people to come take loans from us. And that is very, very powerful. So I would definitely be recommending that you guys consider that. Now, I must say, from the retro analysis we've done, we've not actually launched our new product yet, but that's going to happen next month. So we're excited about that. And I think I can just say, watch the space. But hopefully, if there's another session, maybe in a couple of years' time, we may be able to share with you our findings and the challenges we've faced. So I'm just going to conclude here with a cover for my thoughts. And this is just how do we move from here to where we want to be. Just based on my experience as an outsider coming in, seeing exactly what's going on, having done business in Nigeria, these are my thoughts. So education, education, education. Now, what I'm referring to here is that we must collectively bridge that financial literacy gap if we're going to move forward, right? People need to understand why it's important to actually pay on time, why it's important to actually shop around before you actually take credit, and also why it's important that you actually consider whether you can truly afford a loan before you take it. And that education also applies to lenders as well, right? The second is that we need more lenders acting responsibly in terms of data sharing, and also ultimately being prudent when they're determining who they lend to. Some of the experience we found that customers come to us, borrow money from us, we report to all 3 credit bureaus, but then we find that the same customer is able to get loans elsewhere, right? You know, and it's like, that is so irresponsible. And I think we need to see that kind of change in behavior. And I think Jess and Nemeka mentioned that in both their presentations. Now, credit bureaus should also consider what is of greater value to them, right? You know, and that has to do with what is, you know, maximum or minimum participation. A number of lenders, mostly state licensed lenders, refuse to share data with any of the credit bureaus, right? And most of them that I've spoken to, they say it has to do with cost, right? They believe that if they're offering nano loans and the offers the credit bureaus are offering, perhaps make it not compelling for them to do so, right? So I think credit bureaus need to really think as an industry, what is most important? How do we get more data? Because the more data we have, the more compelling it becomes for them to actually succeed as well. So that's just an advice for credit bureaus, if you like. And then for CBN, they need to carry on with their goals of licensing more microfinance banks, mobile money banks, finance houses, agency banks, and importantly, progress its open banking regulation, which I think it's outstanding to see Nigeria leading the way in that regard. And finally, state money lenders, I think, should transition on the CBN regime, right? And I think that is the best way, where we're all playing on the same field and working on the same rules. And I think there would be better outcomes for consumers as well. And I think I've not done too bad with the time, Vera, but that is all from me. I would answer any questions when it comes to question time. Thank you.
Thank you so much, George. You didn't do bad at all. You were spot on with time. All right, so right now we'll go to the Q&A session. Can we have the speakers just turn on their videos, please? So, yeah, so all right, thank you. Can we have, all right, Jess, you can turn on your video. I think the first question is for you.
Sorry, Vera, I was just answering a question.
All right, okay. So the next question is for you, Jess. So someone is asking, what is the impact of the introduction of open banking system on credit bureaus since banks now share API in Nigeria?
Well, I can talk to that from a credit scoring perspective. I mean, open banking is clearly a good thing in terms of increasing transportability and keeping banks honest, I guess, in terms of terms and rates and customer service. But the problem with any data that requires customer consent is that you're going to get a biased population that give you that consent. I mean, if there are problems in someone's financial affairs, they're unlikely to volunteer that through any form of consent for open banking or any other type of data supply. So from a credit scoring point of view, credit bureau data obviously has the full picture of good behavior and bad behavior without that bias of the customer deciding whether they're going to tell you or not. That would be my answer to that.
All right, thank you, Jess. So the next question is for you, James. So the question is, what gap do you think the credit registry preventer bridging in the Nigerian markets? You did an extensive presentation on the identity solution. So what gap is it bridging? How is it different from what we have in Nigeria?
Well, well, thank you. I think that providing the identity verification over the internet through the credit registry services, I think that will help a lot of the lending industry. It will automate process. It will not only automate, but also it will making sure that all these processes doing with the safety and the security process. It will automate them to do the data cleansing. It can help them to renew all the information from the Know Your Customer that is being regulated and is mandatory. But also it will help them to automate the digital onboarding for new customers and for existing customers on new products.
All right, thank you. I actually have another one for you here. You just mentioned it, so allow me to ask you that now. So can you speak a bit more on data cleansing?
On the data cleansing is where we can getting the information from the customer, and then we can integrate it with the smart card, and we can get all the data, and we can renew the information from the phone numbers, emails, and addresses, and we ask the end user by doing the verification themselves, the self-service, to update the information.
All right, okay, thank you. So the next question goes to you, George. You've already answered this question where you, in the course of the presentation, you actually did tell us to watch out for your new product. But let me just read it out. Someone is asking how borrowers can have access to credit from legitimate companies like Money in Minutes, whose services have been inaccessible for a couple of months. So you've already told us to watch out. But there's also another question for you, George. And this came when you were presenting. So Williams is asking if you could explain on the last point on the challenges when you say reasons are alarming.
Yeah, okay, thank you, Vera. So the first question, I think you're absolutely right, I addressed before. We've actually reviewed the numbers of loans we're issuing out on the back of the need to kind of assess what we've already done. And thankfully, we've done a retro analysis with CreditRegistry, so a new product is going to come. So watch the space, we're back in the market. With regards to the challenges, I think I went through all of them prior, and I hope that you could maybe share some of the slides so everyone can actually see. But it ranges from financial literacy, right? People just not wanting to pay because they really do not understand that it is more harmful to them if they do not pay, right? And it's very, very simple. You borrow money from X, you pay on time, is reported. You borrow money from X again, you pay on time. B is already trying to find who you are because of that behavior. And B is going to be able to reduce rates because they want you, because ultimately all lenders want to lend money and they expect you to pay back. So it's very straightforward, but that gap in understanding does not allow people to see those benefits. And I think that is one of the biggest challenges that drives all the other challenges and behaviors and outcomes we see.
Okay, thank you. I also have another question for you. You did mention that you consumed the retro and anonymized sample from CreditRegistry. So I believe a lot of us here would want to know how the retro and anonymized sample that you explored with CreditRegistry helped you to adopt, or did it help you adopt a superior risk-based decisioning approach? And did you actually remove subjectivity?
Yes, it did. It did both, right? So now we've been able to figure out the right product using our internal data and also using the data from the retro analysis to kind of figure out what a true good customer looks like, right? And what a bad customer looks like. And then our data scientists have now built a new model, which we're going to use to go back to market. It also helped us understand what kind of product is right for the Nigerian market. Now, this is yet to be tested, as I said before, but based on data, which, you cannot, data is truth, right? So that is what we're going to rely on, and hopefully we're going to see the result. Another thing that's worth noting, and this is the reason why I said there's no need to run for the hills. Every time we've introduced a beta launch, and then we've stepped back and done some analysis and we've gone back, whether we use bureau data to do analysis or not, we've seen significant improvement. Right? So it's clear that there is business to be done here, but you just need to understand how to do it, right? So we're in that process of kind of figuring it out, and I'm sure that very soon we'll be there with the right product for the Nigerian market, so we can actually accomplish our mission in Nigeria.
All right, thank you. So I come to you, Dr. Liang. So I have a question here for you. The writer actually addressed it to you specifically, and he's asking, can a financial institution depend on a score generated wholly from alternative data for lending? I also know that Jess touched on that during his presentation, but I want you to answer this. Over to you, ma'am.
Of course. So I believe I responded in the in the Q&A session, but thank you for giving me the opportunity to answer here as well. I would like to speak to this subject. I think fundamentally, I think what this question posing is an opportunity to credit bureaus such as CreditRegistry, because what I'm seeing here is that for the credit bureau data, it has a much bigger potential to capture not just the traditional credit product data. So it has the potential to expand and can continue to capture other credit-like products, the data, the usage of those, so consumers' usage of those products that will enhance the credit data. So that for one. And then I think from this person's question, they directly link an informed decision to a very conservative decision, which is not to offering credit product to these customers, which is not necessarily the right conclusion. What the data revealed to us is it helps us to make an informed decision, which is a risk-based decision. And using this data, it really helps us to offer the right product to customers, especially for customers who haven't experienced credit product before. So this to them is also to the consumers, it also serves the purpose of protecting their own interest. I hope that answers this question.
Oh, sure, definitely does. So there's another question for you. This is more like perhaps a prompting for new product development for Kuda, but I will ask you that all the same. So someone is asking, is Kuda's rating score system applicable to any lending outfit, or is it tailored to Kuda alone?
Sorry, can you repeat that question?
The question is Kuda's rating score system, your loan application system, applicable to, can it be used by other lending outfits, or is it just tailored to Kuda alone?
Okay. Well, really, thank you for posing that question to us. I think the starting point is for us to launch our product, and we would like to test it out, make sure that the user experience is perfect. Then, of course, there is a potential there for us to make this into what you call a this product as a service, like software as a service to other lenders. So yeah, thank you. I think that helps us to see the potential for our, yeah.
Absolutely. So I have a question for you, Emeka. Are you here?
Yeah, Vera, I'm here.
All right, okay, good. So someone is asking, so I'm going to ask you 2 questions. I got a question before this webinar. So someone wants you to elaborate on the study reports, on how clear it is compared to other bureaus. And the next question, someone is asking you, what influence do you think the NPR will have on non-performing loans going forward? So the first one, how do you think the NPR? Okay, go ahead.
Okay, let me speak on the credit report. So if you obtain, when you get the CreditRegistry credit report, our report is industry's best. It's easy to read, very easy to understand. I mean, anybody that has interacted with the report will let you know that every information that you require on the report is available there, from the customer's name, customer's personal details, the KYC details, to the most recent exposures that the person would have, and it also shows you the customer's performance across the industry. So, in a nutshell, over time, from feedbacks we have from subscribers that have used our report is one of the most detailed reports in the industry. Okay, so I believe that explains the first question. The second question, you talked about how NPR will affect how NPR will, the impact it will have on the NPL going forward. So it has two major impacts. So one, it can have a positive, it can have a negative impact. So where
my network.
I think it's on mute.
I can't hear you, Emeka. Emeka, we can't hear you.
Can you hear me now?
Oh, yes, please.
Sorry. So I said where it has two major effects. It has a positive and a negative as well on NPL. So where the NPL is increased, it has a negative impact because it puts a lot of pressure on borrowers' capacity to repay. Okay, where it is reduced, also allows the ease of repayment to be achieved within the period, the tenure of the facility that is given. So of course, this is introduced by the government to create a lot of stability in the economy, but this also has to be watched to allow fluidity, to allow the economy to be fluid and allow people that have taken facilities to be able to make payments as I went due.
All right, thank you. So I have a question for George and Yingping. I know Ying touched on it during her presentation, but I want you to further elaborate on it as a way forward for us in the industry. So we want to know, do you think data quality issue is an industry collective responsibility? We want to hear your opinion on that, George, and start with you, George. And if it's yes, why do you think it's a collective responsibility on all of us in the ecosystem? And then I also want, after you, George, you can speak on that question as well.
All right, thank you, Vera. Well, I think it's a collective responsibility because if you think of it as a pot, right, we all eat from the same pot, right? And so if someone is actually coming in with dirty hands, then we're all infected as a result. So I think we're all responsible because we rely on information from here. And I'm sure Jess would agree that this data quality issue is not really a Nigerian problem. It's across, it's global, right? In the UK, we have the same kind of challenges. It might not be as bad as some of the issues we find here, because ultimately the responsibility is on the borrower the lender to pass that information. And sometimes credit bureaus do not have the ability to be able to cleanse or validate the authenticity of that data. So I think it's all about being responsible, understanding that, you know, if you're doing the same and others are doing the same, what's even the point, right? If you get the right things in, you get the right things out. So that is my view on that.
All right, thank you.
And so I completely resonate with George on all the points that he raised. I think for one, he's absolutely right. This is not a Nigerian specific problem. This is a problem that's experiencing across the world. So in the UK, there's also a different degree of data quality issues. So, and they rely on the banks and the lenders to improve their own reporting practice, and as well as the bureau themselves enforcing these data cleansing practice and enforcing the reporting quality requirement on the banks and the lenders. It operates based on reciprocal principles. So I think some of the lenders may feel that they're handing out data for free for others to use, but they are taking they're a beneficiary from this data set as well. So if other lenders behave the same, like providing low quality data, then it would also sabotage the decision they are going to make based on the decision, based on the data. So yeah, it requires the whole industry collectively to act together and improve the data quality. And as then we will be on a positive spiral where helping the whole industry and the whole country, the consumer finance sector, to improve its service to the people.
I'll just add one thing. Thanks for both of your contributions there. I think it's also the case that as credit scoring becomes more adopted, the emphasis on data quality increases. People become more aware that their decisions are undermined by data quality issues. And I mean, if you look at the UK, we've been using scoring for 50 years or so. So there's been that pressure to improve data for a long, long time, which hasn't necessarily been quite the case in Nigeria. Although, on the flip side, you do have a BVN number, which we don't have in this country. I mean, we're in the UK, we are still relying on name and address matching. So in some ways, you're better from a quality point of view. But I think it'll get better still once credit scoring becomes more adopted.
Thank you, Jess. And Jess, I was actually coming back to you as well. So you get to hear a lot of lenders say to you that their decisioning engine is independent of the credit bureau. They don't need the credit bureau. And you get to hear a lot of lenders say to you that bureau analytics can also be my main decisioning tool. How can you help us to marry these two mindsets that a lot of lenders do have? What's your opinion? Did you hear me, Jess?
Sorry, no, please. I didn't know it was coming to me. Please say it again.
Okay, so my question is this, right? So a lot of times you hear a lot of lenders say to you that they can use the bureau analytics as their main decisioning tool, right? And some other lenders are of the opinion that they can give loans without using the bureau, okay? And they just lean on alternative source of data. So what's your opinion with this diverse opinion out there by lenders?
Well, I think at the beginning of my presentation, I talked about a score being a sufficient statistic. It has to include everything, not just bureau data. Clearly, it must include bureau data. You wouldn't want to be making credit decisions without incorporating bureau data, but equally, you wouldn't want to make credit decisions that only are based on credit bureau data. It needs to be a statistically blended mix of everything.
Thank you so much. I needed to hear that from you as we come to a close. So thank you, everyone. Once again, to our speakers, I want to say thank you for joining us today. We've learned a lot. I can see a lot of feedback on the chat. So definitely, credit is definitely the cornerstone of every economy. So it's enabling infrastructure process. Sustainability should be taken seriously, I believe. So I know this is a technical topic for those of us that joined us, and for you to be here till now, I believe is a topic dear to you, and is a topic dear to your overall credit decisioning success. So should you want to engage us further, we're here to listen to you and speak with you. So at this point, I want to introduce to us our MD CEO, Dr. Jamila Sharif, to take the closing remark. Over to you, Dr. Jamila.
All right, thank you so much, Vera, and thank you so much to all of our panelists. You can remain with your cameras on. We just want to say good afternoon, everyone, all of our guests who have joined us, customers, partners, regulators. I see we have one in the midst as well, and all of our colleagues. I just want to say it's been an honor to have you join us today. I hope you've enjoyed the lunch break. We've used your lunchtime to do this. And so we are excited to have brought to you today what we theme as the progressive lender and the credit bureau. We have had an incredible audience. Thank you for all your questions. And just know that this is still the start of a great conversation. If you will, please just go to your chat. Just once more, I want you to take the opportunity just to applaud our speakers once again. That's Mr. Jess Fremantle. We also want to say Mr. Jaime Ramirez. Thank you so much, Mr. Emeka Ezike, and our progressive lenders. Please give them a round of applause. That's Mr. George Debajo from Money in Minutes and Dr. Yiqueen Lian. Thank you so much from Kuda. You guys, we cannot have done this without you. In summary, I just want to say that this journey, it is optimistic. There's been a lot of discussions with our speakers today, and just know that with the right tools and progressive players like Kuda and Money in Minutes, the financial inclusion goal is definitely something we can achieve. If we look at many accolades that Nigeria gets, you're the largest economy. We also have, the largest population. We have just been started open banking, the first in Africa, as George had mentioned before. There's so many accolades, but honestly, all these mean nothing if it doesn't help our consumers and help our people. And so this is one major reason that CreditRegistry started 20 years ago. What differentiates us as a developing country from developed countries is access to credit. It's one of the major things that if we can get this right in our country, in Nigeria, it is what's going to open up a multiplier effect across the board. Our mission is to be that premier information provider and solution provider that is going to bring about new levels of trust, is going to bring about social accountability and improve standards of living for the consumer. And that is our goal. If we can do that well, a lot of the things that we are experiencing today with high poverty and things to that effect, we can begin to eradicate those things. So I'm going to put a challenge out there to our progressive lenders. The next time we come together, George and Yiping, I would love for us to do this as an opportunity to reach those masses. We talked about financial literacy, and George, I think you also put this very well, education, education, education. It is one of the things that we've put on our mission for this year is to reach to all the consumers. We're sitting on top of millions of them, and we want them to know that not all money is good money. What does it take to truly assess, find the right, financial partner when you're trying to get access to credit? And you guys, you have some great companies. I would love to put that challenge to you to let's put together a program that we can go to and reach those consumers and help them and educate them to improve financial literacy. The next thing, I also want to put a challenge out there for us, and this goes to all of our clients. Honestly, we have to put just as much emphasis on the benefits to good consumers, good borrowers, as we do to the consequences. So what can we do to better reward those consumers that are taking money, that are being responsible with their funds and paying them back on time as when due, and that have good credit scores and that are building good credit scores, what benefits can we give to them? And so those are other challenges that I would love to see us begin to work towards as we do this. And the last one that I want to mention here, and is speaking on the topic you guys talked about, which is reciprocity. The Bureau is here for the lenders to honestly benefit, to find the best customers for your products so you can be profitable. And that does cost. It does have a financial cost to everyone. But as a Bureau, we take that as our main responsibility. So reciprocity, giving data on time, all the time, so all the players in this ecosystem can benefit is so important. Jaime talked today about a data cleansing solution that we have. That is one that's immediately available. If it's just one thing you can take away, if you're a lender on this meeting, get to us and let us help you to improve your quality of your data with our data cleansing. That's going to help everyone in the ecosystem. It costs you, little to nothing to do that in order to make sure that the data that you also get back is just as valuable as the data that you put in, or even more valuable. And so with that, I just want to say these challenges, I'm throwing them out there. And again, our next time, I really do hope that we can reach the consumers and improve the education. So thank you, everyone, for your time today. And we look forward to being with you again. This is the theme, the progressive lender, and there's so many other opportunities and topics we look to bring to you. Thank you. Thank you, everyone. And to my team, thank you as well. Fantastic team putting it together, moderator as well. So good day, everyone. Enjoy the rest of your day.